Welcome to another session of the Emergence Global Conference. I'm Rhythm Gupta, your host for the day, and I'll be moderating today's panel discussion on ESG investing. ESG investing has been gaining traction in recent years, and as you know, global institutional investment in ESG assets was 18.4 trillion US dollars in 2021 and is projected to increase by 12.9% CAGR. However, despite its growing popularity, some governments have used financial and legal means to stop ESG-related investments of pension funds. Therefore, we believe that this panel discussion will provide valuable insights into ESG investing and help our investors practically incorporate ESG preferences into their investment decisions. We have three very distinguished panelists with us here today, and I'd like to take a moment to introduce them to you. First, we have Jeremy Biggs, the co-founder and CEO of Mizio, the world's first artificial intelligence sustainability operating system. With over 15 years of experience in enterprise technology and a track record in digital transformation, recycling traceability, and business advisory, Jeremy has a unique ability to envision a larger picture and develop global solutions that address some of the world's most urgent challenges. Next up, we have Jackie Bloom, the Growth and Investment Director of Startup Bootcamp. With over 25 years of experience starting and scaling businesses, Jackie is a seasoned entrepreneur who now focuses her energy on ventures that are purpose-driven. She's committed to making a difference and impacting the lives of others and has mentored inmates in prison, volunteered on philanthropic committees, and is an active member of numerous female enterprises. She's passionate about growing the startup landscape in Australia and bridging the funding gap for female founders. Finally, we have Giles Ganaswera, the founder and CEO of Global Impact Initiative. With nearly 30 years of experience building and developing businesses for global organizations, Global Impact Initiative is the only impact investing business in the world, acknowledged by the United Nations as a global-led company. In January 2023, Giles was awarded an Order of Australia Medal for his service to social welfare and to the community. Giles holds numerous volunteer not-for-profit directorships and is a director of ASX-listed company Magnus Energy Technologies. Welcome to all our panelists. Thank you for joining us for this discussion today.
Thanks, Rhythm. Great to be here.
Brilliant. Perfect. So let us start with our first question. So ESG investing is often seen as a way to align investments with personal values and support sustainability practices. How do ESG factors inform perspectives of risk and return, and how does the relationship between environmental and social impact and financial return vary for different assets? Giles, would you like to start us off with this question?
Yeah, absolutely, Rhythm, and thanks again for the opportunity, and particularly to be on this panel with Jackie and Jeremy. It's fantastic. It's all related, is the short answer, Rhythm. And becoming increasingly more so. So it's really interesting when you compare the discussion of ESG around the world, and for simplicity, I'm just going to break it into three areas. So the United States, Europe, and let's just call it Asia or Asia Pacific. In Europe, ESG is done, so they don't really talk about it anymore because it's embedded into what they do. So whether you're a government organisation, whether you're a corporate, whether you're an investor, a not-for-profit, a social enterprise, you've been thinking about ESG for a long time. You've been doing it. It's implemented. It's in process. It's embedded into the culture. Here in Australia and in other parts of the world, we're still talking about it. And I'm not going to characterise Asia as one homogenous, block of countries, because it's definitely not. But it does vary, and the discussions are being had in all parts of Asia, as it's been happening in the United States. But what investors are realising, what corporates are realising, is that there is a direct link, as there always has been in financial markets, between risk and return. So if you've got a methodology, or if you've got a way of reducing your risk, i.e. to think about the environment, to think about social, and to think about governance factors, why wouldn't you? And the other thing that is helping, the adoption of ESG and impact investing is, firstly, customers. Customers are demanding that companies do better and that companies think about their packaging. They think about how their product is consumed and disposed of. They're asking companies to think about how they're treating communities, marginalised groups, women in the workforce. They're getting companies, I know, having worked in funds management for a long time, getting companies to think, listed companies and unlisted companies, getting them to think about the composition of the board. Is it right? Does the diversity, does that increased diversity add to the decision-making process, or does it very much look the same? So, as I said right at the outset, and then I expanded to give you a very long answer, Rhythm, that is that they're all related. ESG can certainly inform the risk, and paying attention to ESG from a risk perspective can help you enhance your returns. And also that goes right across asset classes. So you can apply ESG and impact investing tools and techniques to equities, to property, to fixed income, even to cash. It can be done right across the spectrum. There is a link there, and thinking about ESG from a risk perspective can actually help enhance your returns.
Brilliant. Well, thank you so much for those insights, Giles. Jeremy, Jackie, would you like to add something to it? Your thoughts?
I'd love to jump in there as well. And Giles, thanks so much. I think it's an awesome overview from a market standpoint. The only thing I'd like to tip in here as well is thinking through how organizations are attracting talent. Looking at reports that have come out recently with some of the big four, Deloitte, KPMG, EY, there's a consistent theme across the board around how do you attract the best talent into your organization. A byproduct of talent acquisition is that you're getting the brightest minds in the world to help develop your products and service your customers, and then thus commercial returns as well. And I think it's the next big growth driver, right? This is the most exciting part of ESG and sustainability as a whole. Demonstrated through Europe in respect of having this new core standard that is now being adopted throughout Europe. And organizations need to recognize that this is a very simple a process of doing the right thing, operating more sustainably, but doing it in a way that attracts that talent, attracts new customers into your business, and the byproduct being the bottom line. And I agree with Giles that it goes across all industries, all business sizes as well. I think ESG historically has really been talked about at the top tier, large listed organizations with the regulatory compliance and all those frameworks in place. But it really is as simple as if you're a startup versus a listed business, you have the same priorities. You want to get a good return on investment. You want your business to grow. You want the right people in your camp. So it really goes end to end, and it's a simple game of doing the right thing.
Actually, Jeremy, I think even more so, it's probably even easier for a startup because they don't have to retrofit it. They can, and in fact, more often than not, what we're seeing is that the sustainability and the impact is actually driving the purpose behind the startup as well. So how can they create more, or how can we essentially create more of that global economy and circular economy by looking at the impact, but also the investment, and then also the risk. So I think from a risk perspective, it doesn't necessarily change the landscape so much from a startup perspective, because the process of getting a startup off the ground is still relatively the same, whether you're incorporating ESG or not. But it certainly brings about a much broader audience in order to help back the early stage or the startup, because ESG is such a massive consideration now, and sustainability around not just the impact that the startup can have on ESG considerations, but also the impact that it can have internally within the company as well.
Good point.
Well, thank you so much for those valuable insights. Now, see, investing in gender equality and housing security are also two areas that are of interest to many investors. And Jackie, as a leader in sustainable investing, your insights on this issue would be very valuable. So, would you like to start by sharing any success stories or challenges that you've faced and your thoughts on this?
I think, Rhythm, that the biggest issue, particularly around gender equality and diversity, is very much the lack of investment available for, or the lack of investment deployed to female founders, first and foremost. And that's something I am very passionate about, not because I'm any sense of the word, an extremist, but it's more about just having a fair go, right? Giving women just as much opportunity with funding than our male counterparts. But I think, Rhythm, it even extends further to the number of women in positions of empowerment or in positions of decision making when it comes to investment. And that's an even bigger issue, I think, globally, where only 14% of women sit on investment committees or decision-making opportunities for that investment. So from a female perspective and diversity and gender equality, that's one of the biggest reasons why I champion it. But then we also look at the stats here at Startup Bootcamp as to, what numbers are coming through and what investment or what information is coming through around where the investment is going. And the way we focus on it is when we're looking at our scouting and the startups that we bring into our programs is very much around ESG considerations and how are they going to have an impact, not just have an impact on, but be impacted by some of the sustainable development goals. And so we then break it down into themes depending on the vertical that we're working on. But for example, with our sustainable fintech program, we've now broken it down into 3 significant themes that incorporate 8 of the 17 sustainable development goals that will actually have an impact on who we bring into the program as well, because they need to be able to demonstrate that they're working towards making a change in that sector.
Absolutely. Any thoughts that you would like to share, Jackie? Jeremy.
I think the key question that's in my mind here, and I recently had a conversation with some of the team at in the high growth ventures team in KPMG about this, and we really need to push the investors to ask the right questions as well. Startups are a great ecosystem to set the right foundations, and as you say, Jackie, it's the perfect time to actually set that into the governance of the organization. It's just what we do around here, right? It's the underground ground rules. This is the core in respect of what we do, whereas retrofitting is more difficult. But when regardless if it's a seed round or if it's a pre-IPO, investors need to be asking the right questions. Where's the data that you have on your board? As you said, female founders and supporting diversity, inclusion throughout, and even from the environment side as well. What are the net impacts that have been made in the organization, right? So in due diligence, we might cover it a bit more later on, but I think it's really interesting to understand what questions are investors asking today. Yeah,
100% agree with that, Jeremy. It's very much around that due diligence piece, which is something that I also figure we'll unpack a little bit further down this conversation.
And just to pick up on Jeremy's comments there, for us and particularly our work in gender equality, it's really come from a place of human rights. And I'm unashamedly a 32-year member of Amnesty International. So most of my thinking and influence, really comes from that first perspective of, let's look at it from a human rights perspective. And from a human rights perspective, you have 50% of the population being women, not getting the same opportunities as the other 50%. So that's started our journey, and a long time ago, started our journey into gender equality, but then positioning and constructing investment funds that then meet the needs of investors that want to invest in that, but then also a product or a structure that can then deliver both financial returns as well as that social impact. And our Gender Equality Fund is a good example of that, where investors get a return from investing in a portfolio which has no exposure to alcohol, gaming, tobacco, weapons, fossil fuels, adult entertainment. But then we've run a gender lens through the portfolio. We're looking for companies that have women, a high percentage of women on the board, women in senior management, family-friendly policies, parental leave, pay parity, the whole bunch of quantitative and qualitative factors. And then have established relationships with 5 not-for-profit partners who help us accelerate girls' health, education, nutrition, and social and economic empowerment. So in one product solution, you're getting a financial return, but social impact as well for women and girls. And then we adopt that very same approach when we're thinking about health, or when we're thinking about housing, or any other, or Indigenous communities. Adopting that. What do human beings need? What are they currently not getting? And let's solve for that. And at the same time that we're solving for that, using our knowledge of investment markets, using our knowledge of financial markets to ultimately provide that solution.
Amazing. Thank you so much for sharing your insights on this particular issue as well. Now, let us move on to practical considerations. So, we touched upon this, that due diligence is very critical for investors, especially when it comes to impact investing. And Giles, as someone who runs an investment firm focused on sustainability, you likely have the best practices to share. And Jackie, as the global head of sustainable investing, you likely have insights into how different investors screen deals. And Jeremy, as a senior advisor on ESG and impact investing, you may have observations on how investors can conduct effective due diligence. So I'm sure our viewers would love to hear from all 3 of you from this issue. So Jeremy, I'll start off with you. What are your thoughts?
I think that there's an overarching theme that we're going to end up going down here, and I'll just say it right now, which is, and this is the key word, which is, for me, is trust. And it goes beyond just, a layman's word. Trust goes into transparency and traceability, all these wonderful things. But if we think about impact investment as a whole, and Giles knows as a specialist in this area in respect of what the expectation is. The expectation is that we get a return on our investment, obviously, but there's a net impact. And this is very simply understood by the measurements that are made along the way to validate the truth and the transparency of what actually is being done and not done. So specifically, when someone talks about impact investment or investing with ESG, some of the things that I have in my mind are where is the trust and the transparency and the evidence that supports the statements that are being made? How do I get access to that information? Is it real? Is it not real? And I think some of these metrics are very, very topical. There was a survey done by McKinsey, I think late last year, that we looked at where 88% of a particular, I think it was a fashion apparel market vertical, 88% of Gen Z just didn't trust brands at all. And they didn't even go into the detail of it. It was just a gut feel. And that's evidence of not having enough information for those sort of more customer-related stakeholders. So you can well imagine, if you're an investor or a shareholder of an organization, you're not hundreds of thousands of people. You're maybe a smaller cohort of maybe a couple of thousand as a shareholder in a company. And it's easier for an organization to articulate that clearly to a smaller cohort. So I question where the barriers are, because if we have the right information and we're doing the right work and we have the right measurements in place, surely we can build upon that as a trustworthy source of truth and share the progress that's being made over time. And all of this is a product of work that needs to be done. And the byproduct of this is in this reporting that we end up with.
Yeah. And I was going to open that up also, Jeremy, and say, you talk about measurement, but what is that measurement, right? What do you use to measure that? And unfortunately, at the moment, if there's no global, tool that is going to be used across the board, what does that look like? And so each organization or corporate entity could be using a completely different tool, which might end up with a different result, but still say, no, you can trust us. And so how is that overcome? I mean, I know it's being worked on at the moment, but certainly the from this perspective in terms of sustainable fintech, I know the Australian Sustainable Finance Institute is working on a global scale to rectify that and to come up with a solution. But what is the solution in the interim?
I think
I'm not the one asking you questions.
No. I think if I can jump in, Jeremy, I think in the interim, it's what Jeremy is referring to around trust, but it's about communication. So you're absolutely right, Jackie. There is no standard. There are standards developing. There's good and bad standards that are developing as well. The thing I am not comfortable about is waiting for a global standard, because it took us 182 years to get a global accounting standard. We don't have that time when we're talking about climate, and we're talking about gender equality and Indigenous communities and health outcomes for our planet. So we need to adopt the framework, and whether that's the UN SDGs or World Bank guidelines or the different guidelines out there, adopt what you can, measure it, report on it. The great thing, as soon as you adopt a framework and you start reporting on it, it does raise your consciousness. No one wants to be putting in writing or reporting on something that's untrue, or making up stories about impact or about outcomes that not necessarily there. And I always say to my clients is that you got to start somewhere, because find that value, find that area that is passionate to you. If you're a corporate, it could be something that's relevant for you as a company, for your employees, for your customers. But just start doing something, because you can always expand on it. I'd much rather companies and investors start with something and expand than pick off, bite off something that they can't chew and then have to reduce their reporting. So Jeremy, you're the expert in reporting and measurement, so I feel fraudulent even talking about it. So please jump in.
I think that's a pretty good summary. I like to get some clear examples of what this looks like in the real world. So even in Australia, we've got the Modern Slavery Act as an example, and you can well imagine internally in a company, it's a lot of work to be done, but it is relatively straightforward. So go, hey, what are the standards and the plans and things that exist around the world that align us to eradication of modern slavery and reporting of modern slavery? But if you go just one or two layers deeper, you got to recognize that modern slavery reporting requires you to go quite deep through supply chain and into areas that are very gray. And people that have child labor and are using things and have criminal activity in their organizations are criminals, and they are specialists at covering things up. So it is almost impossible to have a complete end-to-end supply chain in a business with an organization going, yep, we know that everything is correct and true. And I think to your point, Giles, what this brings us to is it's not about being perfect, but it's demonstrating the incremental improvement that you're making over time. And it's okay not to have the answers as long as you can demonstrate that you recognize that there are gaps and there are gray areas. And I think this is where we've gone with ESG, is that it's become a checkbox exercise. And again, I go back to the framework. If we're doing the work and we're sharing the progress over time, transparently, it creates that trust. If we've got a framework that we've decided to use, fantastic. We've got the plan. We're making incremental improvement and we're sharing it with stakeholders. To your point, communication is critical. And I'll circle back on the communication piece at the end. But this really underpins a very simple foundation layer to go, this should be the priority at a corporate level. And then it's about implementing that priority in the company.
And interestingly, we also see it open up a whole new sector of innovation as well. It's a whole new vertical for innovation, because all of a sudden you've got all these new startups working on, ESG reporting and impact reporting, and what does that look like? And there's different apps that are coming out and different platforms that different companies can use. And so even more reason, Giles, to your point, is that we need to be focusing on that change and that global the global reporting now, or as soon as possible, because then we are going to have completely different standards across the world as well.
Yeah, and as you say, Jackie, the benefit of startups is that they can do it from day one. And the majority, not majority, being very generalist there, but a number of startups, start up an organisation because obviously they see a gap, they see a need, it's something that they're passionate about, but quite often there's an alignment there between their own personal values. And that's what we continue to see in this space, investors that are saying to their private banker or their financial advisor saying, I only want to invest in gender equality, or I want to invest in gender equality and climate. Go out and find me product. That's what I want in my portfolio. I don't want oil and gas companies, and I don't want pornography companies, and I don't want gambling stocks. This is my values. I'm going to. This is my money that I'm taking to retirement, and I want to build it in a sustainable way, and not in a way that is totally against my values. And then interestingly, millennial, younger investors are saying that and doing that. And interestingly, at the other end, the baby boomers, parents that are transitioning this wealth are also saying, okay, well, let's start making those changes now in the portfolio, and let's start looking, for those. So if their children aren't putting pressure on them, their grandchildren certainly are. Or they're putting pressure on themselves to say, okay, well, it's time to do the right thing.
Yeah, and I think the same thing from an investment perspective. Going back to Jeremy's point around, the word that they use is trust. Mine is very much values. So nowadays, if you are going to be investing, even from that risk perspective, it's will do your values align first and foremost? Because if they don't, well, there's no point, and you're not hitting the mark on your ESG considerations for yourself personally as well.
I say as well that there's probably this is a lens of doing the right thing. There is a counter argument, not an argument, but I think that there are a lot of investors, be they private or sophisticated, that are still chasing just the near term return on investment and getting the short gains, which is currently fueling a lot of the markets at present. And in the absence of regulatory compliance, particularly in Australia, it's very difficult to curb what that looks like, right? When you've got such a demand for perceived near-term growth, from a profit perspective at the investment level. That's top end of town listed organizations, but certainly the smaller end of town. When we think about startups, we think about corporates in the mid-tier that don't currently have the regulatory compliance. I always talk about, why would you care about operating sustainably? This is our core message that we talk to businesses about every day. And it really goes back to the core of, it's going to get more customers, it's going to attract more investment, it's going to attract more talent into your business. It's a core foundation layer that underpins the future long-term trajectory and growth of your organization. It's worth investing in. It's an investment internally to give you a better return as well as your shareholders.
And those short-term gains can easily turn to long-term losses if you're holding, stranded assets, like, for example, coal mines, because you wanted to go into them for the short term and you haven't got out in time. You're now holding a stranded asset that is not only not doing well financially, but doing even more poorly for the environment.
Our job is to fuel the companies of the future that are doing amazing things so that they have got results that completely crush, some of these other near-term investors. And I think there's actually a lot of exciting innovation happening around the world. There's a very exciting time right now, huge opportunities around the world.
Definitely.
It's very exciting.
Brilliant. Well, that was very insightful. I myself got to learn so much around that topic. Now, ESG reporting has become increasingly important for investors, and it's also important to understand what investors are particularly looking for. So, Charles, I would like to start off with you. Like, what do you think investors expect when it comes to ESG disclosure and reporting, and how do these expectations actually differ based on the type of investor, sector, or asset?
Yeah, I don't see a lot of difference rhythm between investors, sectors and assets. I guess if I take a very simplistic example, a fund manager that invests in circular economy initiatives. So they're investing in circular economy initiatives because they believe that those initiatives, i.e. turning waste into energy, recycling, those sort of initiatives are going to create jobs. They're going to create jobs, employment, training, but importantly, help reduce the carbon that's in the environment and reduce waste as well. So they have to, tell their investors, this is what we're doing. This is how we're doing it. We're now going to measure, we're going to measure employment. We're going to measure carbon. We're going to measure gender equality. We're going to measure inclusive communities, sustainability. So as long as they're upfront around what they're measuring, how they're measuring it, what's the impact that they want to create, I'm comfortable with that. So, going back to our previous examples around previous discussion, I should say, around standardization, this is why I think it's really interesting to not have standardization, because a fund manager reporting on gender equality initiatives is going to be quite different to a fund manager reporting on within a climate fund of funds example that has investments in solar, battery, wind, water, and circular economy. So there will be definitely some crossover, but there will be different things that they're going to be measuring and reporting on. So I'm comfortable, as I said, going back to first principles that Jeremy mentioned around trust, but mine's definitely around communication when it comes to ESG reporting. If you tell people what you're doing, how you're doing it, and then you report on it, you put it in writing, and that's both if you achieve it or if you don't achieve it, that's half the battle. Because at the moment, there are people sitting on the sidelines saying, oh, there's no standards, there's no this, there's no that, I don't want to start. And so they're just not doing anything. Now, there'll come a day when ASIC knocks on the door, or a regulator will knock on the door and say, why aren't you? So I'm saying to companies, well, just start, just do something, and be transparent about it, but ultimately just start and communicate. But Jeremy's probably much better place, but go for it, Jackie.
No, I was just going to add to that consistency consistency across the reporting. So, if you are sending one message, that makes sure that, you're reporting consistently across all of your mediums.
Yep.
I take it a very simple lens with this as well. And I've recently done some analysis on a couple of market verticals. I won't go to all of them, but if you just have a quick look at some of the top companies in the world and go to their website and work out how long it takes you to figure out, how do I find the information that this company is working on in respect of sustainability and or ESG and any of the areas. And once you find it, to what depth of information is publicly disclosed that I can understand? This is the key as well. And I found that, 99% of websites generally and communications don't include the narrative, right? It's all about the commercial growth, and nobody's thinking about the underpinning foundation values that set the organization aside. And I think we need to really think about how we articulate the progress, the incremental progress, and have that done in a way that it's easily understood, easily accessible. And I think you nailed it on the head there as well. How many reports do we read where it says, "Hey, we set this out to achieve this target. We actually missed it. We didn't get there, right? And we didn't get there because of X, Y, Z." It's very rare that you find that kind of narrative inside of reporting at the moment as well. And I think we need to highlight and probably celebrate, when we find things like that, because it's an opportunity for growth and identifying other growth pathways for companies as well. I've got some young boys, and I battle test a lot of business things around them. At 10 years old, I can go to someone, "Hey, do you understand what this means and what this is?" And if he goes, "No," I go, "Well, we failed." We need things that can be understood by everybody, not just by the analysts sitting at the banks or the big funds and the VCs. So simplification that is underpinned through validated provenance, the data metrics, obviously documentation, these things is really key. And I think a nice, clear, concise message that tells everyone the progress that you're making over time. And the standards will come and they will change and they will adapt. And the pressures will come and they'll change and they're going to adapt. I think the key message
Jeremy,
to your point, Charles, is just get going. Yeah.
I think the challenge I raised to you is, what do you do when those those young boys become teenage boys like mine do, and they go, "Mum, I can't be bothered reading that, so don't give it to me to read." So
pocket money.
That's my challenge to you is when that happens, come and talk to me because I'm
Slide the incentive, Jackie.
But I think and I think a really and this is something. This is something that I'm really passionate about as well, is that it has to come down to education, but it comes down to education at the informative years, the early years. The younger they are, the younger we can actually teach them that gender equality, has to be first and foremost the way forward. That we can't have discrimination and all the issues that we've all grown up with, and the sooner we learn that and the sooner we bring that into our everyday education system to actually make these changes and have that impact, the sooner we'll actually be able to make a difference. And it's the same, as Jeremy, I do have 2 teenage boys, and it's not okay that the funding gap is so significant across, for women. And at the same time, though, I'm not going to then discriminate against my children because they're white men or, young white men. It's actually much more of an inclusive conversation, and it has to be an inclusive conversation from the bottom up, not just the top down.
Well, the great thing too about what you've raised there, Jackie, about this conversation is that this is also a big passion of mine, is financial literacy. We just
100%
at school, we don't get taught how to do a budget. We don't get taught what happens when you don't pay off your credit card. You don't get taught how to choose the best mortgage. You don't get taught, especially in Australia, it's absolutely nuts. We don't get taught compound interest.
You don't get taught how to invest.
Yeah, I mean, we're sitting, as soon as you hit 16, you're sitting on superannuation, and most 16-year-olds would have no idea how to invest it and probably do something silly like stick it in cash or fixed interest as a 16-year-old and wonder why there's very little there. This is a great conversation around financial literacy and values coming together. So invest with your values, but at the same time, learn these basics around financial literacy, which will set you up for life.
And it will also set up, things like which car, my boys are now ready to drive. So what car am I going to get? Do I get a petrol car or do I get an electric car? And what is affordable for them at this age as well, right? So it opens up all of these conversations, none of which they typically have at school at the moment.
No, sadly.
Very well said. Well, thank you. That actually brought up very good insights, which I would agree as well, because I came at a very graduating from university in Sydney, and then obviously these were challenges that I faced, which when I started working, I realized that it would really have helped if in university these topics were at least touched upon. I know they have a curriculum to follow, but it's a very, very good point that you have raised, and it gives us a lot to think about as well. Now, impact washing is a serious risk for investors, and it's important to understand how to identify and prevent that. And Jeremy, you have written about the risk of impact washing in ESG investing. So would you like to explain what that is and how investors, fund managers, and prospective portfolio companies can prevent it?
Well, I think just off the bat, we think about impact washing and greenwashing and these areas. It goes back to that communication piece as well. But this is, and I think that there's different layers that need to be considered. In the first instance, sometimes this can happen, without any intention in mind at all by an organization. And that is simply because the due diligence internally has not been done with providers to understand exactly what things are. And they don't necessarily have the specialist advisors supporting their journey as well to determine that this is right or this is wrong. So I think there's a lot of that going on. And what happens now is that we're in a world where it's almost a negative to talk about ESG and environmental social governance, because there's a lens that says there's so much of this greenwashing going on. Is it real? Is it not real? And I think it's put in that too hard bucket really, really quickly. So it's a very serious topic to broach. And when we go into the intentional greenwashing, then it's a different story as well, particularly when we get to things that are concerned around carbon offsets. And before we get to offsets, what people need to recognize is that we first do the impact and reduction and calculations. And we're doing our reporting and our transparency disclosures of the progress that we're making. And right at the end, we've got this little bucket that goes, hey, we've got some emissions that actually we can't reduce further. We've hit that baseline. Now we can start considering what the offset may look like. And then again, validated source of truth around what projects are correctly managed, which are the ones that we can get third-party assurance on that are correct and done and audited correctly as well. But again, I like to simplify things. And for the lens of a business, just like myself, if I went to a company and they had a claim around a particular impact project, the first thing that I ask them is, that's fantastic. Where is the data that support with evidence that supports what you're talking about? Can I click into something and drill down into a reasonable amount of detail to understand? And I've had lots of conversations with some very big foundations around the world, nonprofits, impact funds, organizations, and I feel that there is a pressure cooker of work that is happening at the moment that is really pushing this agenda quite quickly ahead. And we're finding through innovation and through technology that some of these dots are being able to be connected a lot quicker, a lot better, and it's going to improve. But my word to everyone out there, and from an investment perspective specifically, is in due diligence to understand, if I see something, can I quickly and simply validate that it's true, yes or no? I go back to the frame of websites, and having information on a website is great. You can tell a great story, but it actually is meaningless unless it's connected to a standard. It's connected to some form of third-party assurance or an advisor, and you've got the traceability that's attached to it. And this is ground up 101, in respect of sustainability. You don't start the top down the report. You start at the small thing, measuring the amount of soft plastic being used in a business, or understanding the baseline of your carbon footprint, and then measuring it over time. That's the only way to do it, really. Yeah.
Yeah, this space is growing. Yeah, this space is growing at a pretty exponential rate. And it's challenging for, if we just think about corporates, at this point, both listed and unlisted companies working out, well, which firm do I use for the measurement? Which firm do I use for the reporting? Do we do the same? I think one thing's pretty certain is that companies definitely, as Jeremy said, need to get third-party experts, experts, assurances, from these third parties that are involved in this space on a day-to-day basis. And it may sound like Jeremy and I are talking up our own book, but no organisation has an accountant and the auditor who are the same people. But why, when it comes to impact measurement, where are companies even contemplating doing that? And that's where you're seeing some of the issues where companies are saying, yes, this is our ESG policy, great, but here's the impact that we've created, and this is what we've created based on what we know. There's no third-party assurances. There's no different party collecting the data. Even when we measure the social impact of investments, we don't collect the data because I don't want to be responsible for even anyone pointing a finger saying you've manipulated the data to suit your own circumstances. Companies hire us, we'll go and collect the data, but we'll organise someone else to do that, and then we'll report on that and provide a third party report on what's been collected and the outcomes and the outputs, from that. So just strongly encourage companies, investors, any organisation to think about it and get third parties involved in what is a really, really complicated sector, and also get the right impact measurement for who you are. So some impact measurement firms are really good in anything climate related. but can't measure the impact in Indigenous communities. Some organisations are really good with Indigenous communities, but can't measure the impact on in a health project or in a health organisation. So you've got to be able to find the right company that can help you for what you need to achieve.
Mm.
Jackie, any thoughts that you would like to share with us?
I think Giles and Jeremy are well and truly across it all. There's I could add, but I would be adding the same messages as well. So I think for me, the biggest key is also making sure that the reporting and the measurements that do get put into place and that do take place, then also, as a organisation, you also then don't want to be exploited from actually getting those measurements done and reporting on them, right? So there's that fine line as well that you need to consider, and it's a matter of trust. So you're trusting and the values aligned, and you're trusting, making sure that the company who is measuring that impact and who is making that report is doing it on a basis that they actually know what they're working on, and they know what they're talking about, and they know what they're reporting on. And because it is relatively new, particularly in Australia, it is finding the likes of Giles and Jeremy to turn around and say, I've got the tools here, we can help you do those measurements and report on it.
Absolutely. Now this is
and you can pay me later as well for that plug,
right? Absolutely.
So, this truly has been such a delightful conversation, but unfortunately, we are coming to the end of our panel session. But before we close off, it would be great if you could just give us, for our viewers, like any final thoughts that you would like to share, like something which you believe hasn't been covered yet. So I'll just go around the room and just open up the floor to you. Just any final thoughts. So, Jeremy, I'll start off with you.
Cool. Thank you. I've really enjoyed the conversation. Thank you, guys. Just a wealth of knowledge around the table here, and I hope there's good value shared with others too. I think my final thoughts are, and listening to everyone here, is really thinking through, what could be a message to investors, in respect of ESG as a whole, and thinking through, some of those conversations around short-term gains. I totally valid. I understand what that looks like, but when you start unpacking this sustainability in the ESG space, we very quickly realize it's really more about, customers. It's around attracting talent, attracting investment. There's a lot of cost of capital. Even insurance comes into play as well in terms of cost of running business. And also we minimize our longer term risk as an organization too. All of that culminates to a much better bottom line position. We acknowledge that there are gaps and that standards are being developed, and a lot of the reporting frameworks are not yet finalized. But over the next 3 to 5 years, we're going to find significant advancements across the board on a global basis in order for us to achieve the goals. And I feel that there's going to be significant compliance coming in, particularly 2025, 26 with European standards that set a new foundation. So my advice is, from an investment perspective, to do additional due diligence and ask the questions. Do you have the plan? What incremental progress is made, and where's the evidence that you're doing these things, even if it's a simple framework to begin with. And from a company perspective, regardless of size, think about the same thing. Where's my plan? What's my incremental progress? Who are the people I need around the table for me to be successful in this space? And what does it mean commercially and for my team?
Giles, your final thoughts?
Yeah, thanks, Rhythm. And yeah, really enjoyed the discussion as well. There's 3 areas that I see that we can be impactful straight away. Firstly, as an employee, you could influence positive changes within the organisation that you're working for, regardless of what sector that is. And it doesn't need to be, coal mining company, you're now a battery manufacturer. But starting off with some small incremental movements, and that could be as simple as making sure we've got proper recycling, or what I learned recently with a company that I was working with. They had the great recycling bins, but then The cleaner was coming at night time and sticking everything into the one bag because that was easier. So not only have the right colours, but make sure that that's separated properly. And if you're like me, annoying my landlord to make sure that I can see those bins and where it's being deposited to as well. As an investor, so those people listening today are investors, either investing their their non-superannuation monies or their superannuation monies. That's a great place to start, particularly your super. So you might want to start with one asset class and just say, okay, in equities, I'm going to go and find the most sustainable options out there, and I'm going to go to Wholesale Investor, or I'm going to go to my financial advisor or private banker and get them to start giving me some sustainable options in global equities.
Or to start up boot camp, and they could invest in
the
sustainable fintech fund, right?
Jackie, you can get your plug in one moment. Absolutely, I'll give you that plug. Go to the unlisted market and look for female-founded businesses through Startup Bootcamp. The third area is, as a shareholder, we're investors, through our super, and so we can influence those change. And the fourth area is as a customer. So we all buy stuff, we all consume stuff. Start looking at how you buy, how you consume, simple things like, the packaging of the fruit. Do your avocados need to be wrapped up in a plastic tray, or can you just buy them individually? There's a immediate decision that that you can make, and you apply that to all parts of your consumerism. And to borrow that very famous tagline, just do it. Just start in any of those areas.
Absolutely, very well said. Jackie, over to you.
Look, it's hard to follow on from two very esteemed colleagues here. So really mine is short and sharp, but it's, what we covered today, due diligence. Make sure you really do your due diligence and consistency across all the information that is put out there. Measurement. So is it measurable? Has it been measured? And can it be measured? Trust. So as Jeremy very well pointed out, that there's a lot of trust, but trust comes in so many forms as well and has to be executed along the way. Education is a huge one for me. As I said earlier, start both from the bottom up and top down, and let's meet somewhere along the way as quickly as we can. And all of those four things for me come back to values. And so it has to be values aligned. So whether you're investing into something, whether you're bringing portfolio companies into your fund, whether you're making the changes from an environmental perspective, choosing the avocado or wrapped or unwrapped, it all comes down to those values and making sure that we're values aligned and sticking to those core opportunities so that we can make a difference altogether.
Brilliant. Well, that brings us to the end of our panel discussion on ESG investing. I would like to sincerely thank all of our brilliant panelists for coming together, giving us your time and sharing these wonderful insights and experiences with us. And before we wrap up, I want to let our viewers know that we will be hosting the Emergence conference in Sydney on the 23rd and 24th of March and in London on 31st. So if you're interested to learn more about investing and connecting with other industry professionals, be sure to register and attend. Thank you so much for tuning in. And again, thank you to all our wonderful panelists for this brilliant discussion that we had today.
Thanks for having us.
Yeah, thanks for having us.
Thanks, Rhythm. Thanks, Wholesale Investor. Appreciate it.